Homeowners, home buyers, new interest rates, you have to listen to this video. Hey, Halifax, Brenda K here with Halifax Home Selling Group. The sweet Miss Frankie is right beside me here. Cyrus Habibi, how are you?
I'm good, Brenda. Thank you.
Hey. So introduce yourself there, Cyrus, and we're going to be talking about the new interest rates.
Sure, yeah. It's Cyrus Habibi with Premier Mortgage. I'm a mortgage broker here in Nova Scotia.
So as you and I both know, Cyrus, there's so much talk about the new interest rate, how it's going to affect people. And, it's going to affect people that are renewing right now, but it's the other ones we really want to talk about that's going to have it upcoming. So first, let's talk about the terms the government uses. What do they mean by basis points?
Yeah, so a basis point is just another term they use for a percentage in a sense, but 100 basis points is 1 full percent. So 50 basis point, 0.5%, 25 basis points, 0.25%. So think about it as dollars and cents. A basis point would be like a penny. So you get 25 basis point, it's a quarter, it's 0.25%. 50 basis points is 0.5%.
That's a good way to look at it, a really good way. And then they use the term prime rate. So let's talk about the prime rate.
Yeah, prime rate is the benchmark, the prime lending rate. So that's what they base their variable mortgages off of. So if a bank says, we got a variable mortgage at prime minus X or prime plus X, then prime is that rate they use to base the lending off of. Right now, prime for the most part, for most banks, is about 3.2. And they kind of fluctuate up and down based on what Bank of Canada raises their overnight rate by.
So to give the viewers some perspective, what was prime a year ago?
Yeah, prime a year ago was all the way down to 2.45. So prime before the pandemic was 3.95. We saw 3 emergency rate cuts all the way down to 2.45. So we saw it go down by 1.5%. And then just recently, back in March, they went up by 1/4 point. Back in April, they went up by 0.5 point. So we're still well below prime before the pandemic, but prime now is 3.2, but it was about 2.45.
3.2. Wow. So the Bank of Canada puts the rate out. The banks follow it. Okay, but there are some. You work with a variety of lenders, which what makes you so good with shopping for a mortgage, right?
For sure.
Plus, you're the best in Nova Scotia.
Thank you.
So how do different institutions offer different rates? How is that done?
Yeah, so every bank and lender has their own discount, so they have their own rates they offer. For the general part, for the most part, I mean, banks all lending money typically at the same rate. So I mean, you should be getting a pretty similar rate from bank to bank. Maybe one bank is a little bit lower than the other by 5 basis points or 10 basis points or whatever it might be, but generally they're all going to be pretty close. Sometimes there's quite a bit of a difference depending on rate specials or whatever that might be, or just their tolerance and what quarter they're in and where they are for business acquisitions or whatever, right? Sometimes banks are more aggressive in the earlier part of the year and then they kind of back their rates off going to the next later part of the year. So it just depends, but for the most part, they're all pretty similar, but there's a few differences that happen or vary from bank to bank.
Yeah. I mean, I know they all have, even the big 5 banks, they all have their own profit center, depending on how much money they made, how much are they going to discount it. I wasn't sure if the what I call the big 5 has to follow the Bank of Canada to a T.
Yeah, they just raise their rates in accordance with Bank Canada. So if Bank Canada goes up 0.5 point, they'll raise their prime by 0.5 point. So they follow suit based on that.
Okay, but they can discount.
No.
Oh, they can't discount. Okay, that was my question.
A bank can set its own prime rate if they like, but typically if they're lending money at like TD has a prime rate that's 15 points higher than everybody else, but they also give 15 points more on the discount. So TD's prime rate is 3.35, but if everybody else is prime minus 50, TD would be prime minus 65.
Okay, all right, that's how to do it. So I was talking to someone the other day, and they actually were talking to another mortgage broker, and they were told only do variable right now. So let's talk about that.
Yeah, it depends on your personal situation, depends on your comfort level and the risk for fluctuation, risk tolerance you have. It depends on where you are and where the market is. I mean, fixed rates now are cresting 4%. Variables are still in the twos. So given that spread, if you can, if you're okay with some fluctuation, it still makes sense to go variable because of the spread in between the two. The other side with variables, penalties are lower. So it just depends on. This time last year, fixed were around 1.5%. So you saw a lot of people lock into 1.5, 1.59, 1.89, because we're never going to see those again.
Right.
But now, I mean, when the rates kind of went back in the twos and the threes and now the fours, you see a lot of people still going to variable because variable is so low in comparison to fixed.
And this is probably what you just said is the biggest reason that I really wanted to have you on today and talk about this. Because, when people are approved for a mortgage, they're approved on what percentage?
So in Canada, to qualify for a mortgage, you have to qualify at either the stress test rate, which is 5.25, or 2% above your contract rate. So for the longest time, everybody was qualifying at, and stress tests has moved a little bit. It was in the 4% range. Now it's in the 5.25. But for the most part, people were always qualifying at 5.25 because the fixed rates were in the 1, 2s and the low 3s.
Right.
Well, now when they're getting up to, let's say, 3.99 or 4.25, you have to qualify at 5.99 or 6.25. Like the rate that you qualify for is actually quite a bit higher. Variable, you're still qualifying for 5.25, but to your point, you're qualifying for a much higher rate than what you're actually getting. So that's the whole term stress test rate. They're building in a buffer for higher rates in the future or whatever that might be, but they're allowing a tolerance so that if the rates go up, you can still qualify for your mortgage when your renewal comes up.
Yeah, exactly. And that, again, that is why, talking about it, the lender is saying, okay, based on your TDS, you can afford this much. They're using the qualifying rate. However, their payments are here, right? So we see a lot of people, especially younger people, that's a difference. Well, let's do a little bit of math. A $300,000 mortgage at 2% is.
Yeah, it was around 1250 when I ran it at 2% of 189. It's about 1250.
Okay. And in the new rates?
It's going to be about 1500, 1550 if you're calculating around 4%.
Absolutely. So think about it. Your payment's going to jump $300 to $350.
Right.
And I've always done a 5-year fixed term. What I see happening is we live in a world today of stuff. A lot of stuff, right? Sure. And I do too. I'm not going to lie. So these young couples that say a year ago, oh wow, look at the extra cash flow we have, and are buying camper trailers or Harleys, or hey, let's go get a cottage, or and that's what, to me, that's what this video, I want to stress to people in this video today, is it is going to change.
For sure.
Right. So all of a sudden your free spending money, your cash flow, whatever you're using, because everything is so cheap there. I mean, I come get a travel to like a 30-foot travel trailer for $299 a month for 25 years.
Yeah, you can get travel trailer for 25. It's pretty crazy.
It is.
Mortgage, yeah.
It is, yeah, because I went and looked. Not that I was going to buy a trailer. I just wanted to see their plan. Yeah. Because of such a, it was like I think it was like $289 a month or something. It was down in Bridgewater. I won't say the name. Beautiful company, beautiful trailers. Yeah. And so I asked the question on the payment, and he said, well, it's 25 years.
Yeah. It's travel trailers are almost like, they're like mortgages. Like
they're, and so, okay. So now what the point I'm making is that the payment's going to go up.
Yeah.
Yeah. We know right now it's going to be about $350
higher. $200 higher. Yeah.
But we don't know where the interest rate's going to go in another 3 years.
We don't. And if you chew up that buffer that you had, if you're just qualifying for that mortgage at, let's say, 400,000 based on 5.25, yes, you're paying 159. But if that then renews at 5.25 or 4% or whatever it might be, and you've chewed up that buffer that you had. It's not that the bank won't renew you, but it's that you're now going to be in a situation where you're basing everything off of 159, which was just more of a luxury than it was a reality for the long term.
Yeah, which leads me to my next question. You go to renew your mortgage. You now have new debt with your travel trailer, whatever stuff you've bought. Can the bank refuse your mortgage?
Not on a renewal. So for the most part, banks, when they're renewing you, they're going to just renew you. A lot of people don't qualify for the mortgages. Maybe they retired, or maybe they went self-employed, or they quit their jobs or whatever. But on a straight renewal, no. If you want to refinance and pull money out of your house, you have to requalify. If you come to me and you're like, hey, Cyrus, the bank I'm with right now is not offering me the best, renewal terms or the best rate. Can I switch it over to you, to a different bank and lender? Sure, but then you have to requalify. So you're, in a sense, you'll be handcuffed to your bank or lender and just doing a straight renewal, because you won't be able to qualify anywhere else.
That's right. Yeah. And when I think the biggest concern that I would have is that your monthly cash flow, it's going to affect it. So it's going to affect it on groceries. It's going to reflect somewhere, because your payment is up that high. So just a little side note story, because when we were young, we bought different things. We're like, ooh, it's only this much for this long. And one time we bought one of those sea-doo boats. Right. And we were young, the kids were young, and the payment was like $99 a month. Now I'm going back to the 90s. Okay. Sure. So it was $99 a month, and we had it for about 6 years. And I was like, okay, had enough of the boat. Let's sell it. Mm-hmm. We owed more than we paid for it still. Yeah. Yeah. The interest rate was we didn't know, right? Like I said, you're young and foolish, and you go to the boat show in Halifax, and you're, so I guess, and that the reason I tell that story, Cyrus, is because, there are people that will say, well, I'll just sell whatever if the payment changes.
And usually those assets, or not, I should even call them assets, but usually those things that you purchase are depreciating assets.
That's
cars, right. Boats, motorcycles. Very rarely where those things appreciate. In this, in this world now, some stuff's gone up in price. But like you said, you're usually not going to sell that. If you finance that, you're usually not going to sell it for a profit. You might be on the hook for some money, right? Yeah.
Yeah. Well, we actually sold it, and I ended up having to, when I got the money for the boat, I ended up having to put $3,000.
Yeah.
Yeah. It was a Hong Kong bank.
For sure. Yeah.
Young and stupid. I don't even know what the Hong Kong bank was. I didn't even know where it was.
Yeah.
So and I think that's the point of this video today. And thank you so much for helping me here explain this to people, and to anybody out there. Like, if you find value in the videos, please hit subscribe. Here's I guess my best advice right now is, if you're 1.5 and it's going to go up, take the payment that would be on the full, say 5.25. What would your payment be at that? Put the difference away.
Right.
Tuck it away somewhere, because it is a shock. And what I saw in 2008, I remember when the interest went in 2008, I remember the interest went from 5.25 at the actual interest rate, and it went down to 4.99. Well, I was so excited. I mailed flyers out everywhere. Hey,
Right.
But at the same time, what they were doing is they were giving 100% finance, and 4-year amortizations. So
0% down on rentals.
Right. So at the end of the day, they were actually financing more than 100% of their home, which, in the end, there were people that lost their homes, and it was sad. And I sold a lot of foreclosures back 2010, 2011. So, and as I know that you don't have any young children yet, but myself, like, once you start with the children start to grow, that's when they get expensive.
Yeah, of course.
So you need that. Yeah, they do. Yeah. Mine are gone now. Yeah.
Yeah.
I wouldn't feed them any cheese. I was like, get out.
Yeah.
I'm done. Cyrus, thank you so much for tuning in, and
Thank you.
thank you, Halifax. If you have questions, send me a comment. I'll send you Cyrus's information, and I'd love to hear any comments you have on, are you one of those people paying that low mortgage? Do you have a plan for when the mortgage goes up? So, Cyrus, again, thank you so much. I am Brenda K. The sweet Miss Frankie is right here beside me. We'll see you next Thursday. There's a new video in the corner up there. Check it out. Cheers.